hold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
On radio, on podcast, and online, helping people discover, protect, and share true financial independence. You've tuned in to the Get Ready for the Future show from the 6th floor of 3 Financial Center in West Little Rock, home to the GenWealth Little Rock office. My name is Scott Inman, along with me, co-founder of GenWealth Financial Advisors, John Shrewsbury. Welcome aboard, sir.
Glad to be here.
And we've got questions again on today's show that we are going to work through and help you answer, and it is all about helping you discover, protect, and share true financial independence. That's our vantage point. That's what we help our clients with on a day in and day out basis, making the right money decisions that will help you on your journey, on your path to reaching true financial independence. Not always black and white, not always right or wrong. Sometimes a goal needs to be set, and that becomes the priority.
Yeah, and obviously there are situations that dictate different answers to different questions. But obviously there are some foundational things that we go through on this show on a regular basis. So building off of that foundation is kind of where we begin to do these, answer these questions, because they will pose a question and give us circumstances, and we have to kind of conform to that.
Yeah, they really need a 2-hour meeting for us to have all of the details.
Yes.
We only have a few things when we get these questions, but are you ready to dive in? Let's go. Greg from Little Rock's first up on the show today, and he writes to us, I have about $1.8 million, but it's scattered among multiple different 401ks and an IRA. What steps should I take to consolidate/simplify my accounts without creating a major tax event? Well, Greg, thanks for the question. Consolidation is a key thing to consider, especially as you get a little closer to retirement. I think about client stories here that I hear all the time. I have one client that really became more focused on consolidating accounts after dealing with the estate of her deceased father, because he did not consolidate accounts, and she had to go so many different places, make so many different phone calls to round all that up and figure out where everything was as the executor of the estate. So it can be very important to have it all in one place. But let's walk through the different scenarios and the different things you need to consider before making decisions if you have dollars in different retirement accounts. So he mentions the IRA. We'll kind of take that off the table for now because it's kind of where it's going to be, right? I mean, it could change custodians, it could change advisors, but the IRA is going to be the IRA. Let's talk about, John, the multiple different 401ks.
Yeah, if you've got a lot of different 401ks, we kind of call them orphan 401ks. If you have an orphan 401k, meaning that you have left it behind at an old employer, then you've got some choices to make. Now, you've obviously defaulted to leaving it where it is, and you can do that. There's no law against that. There's no, condemnation on that or anything of that nature. But to be more effective, you might consider consolidating that into your IRA account. If you don't have an IRA account, creating an IRA and almost making that IRA your lockbox, if you will, of all of your retirement accounts that you have out there. If you can kind of think about this as your timeline of working, and the average American has 7 different jobs throughout their lives. And so if you leave 7 different 401k plans behind, then what you've got at retirement is a big mess that you are trying to figure out, okay, how do I actually turn this into an income plan? So what we oftentimes ascribe to is the idea of just rolling those dollars over into an IRA account and taking it with you as sort of your IRA account, and the employer account becomes your account at that particular point in time that you separate from service. So in this case, Greg in Little Rock has several different IRA accounts spread across different custodians at different jobs that he's worked at. So let's talk about what's going on with Greg right now. More than likely, he's getting all those statements. More than likely, he has lost touch with what is really going on in each of those individual plans and probably doesn't have as up-to-date information as he needs to have on the investment options and all of the plan provisions. Just imagine trying to manage all that stuff at one time. And I think the IRA does give you some consideration there, but there are options that you have. First of all, as we said, you can leave it in the old plan. Secondly, you can transfer it to a new plan where you work. Most 401k plans allow for transfers of your old 401k into the new 401k. There are pros and cons to both of those ideas, and the obviously you are keeping up with it if it's with your current 401k, but you have all your eggs in one basket and you're limited to the investments that the new 401k currently has. So Scott, there are things that you can do. You can leave it in an old plan, transfer it to the new plan, transfer it to the IRA. But I think universally, one of the things that I think Greg alludes to here, and what we never recommend to people unless there is some dire emergency, is cashing out that 401k.
Yeah, so without creating a major tax event is a goal of Greg's. And if he leaves it in the old plan, if he rolls it to the new plan, or he rolls it to an IRA, that is not going to create a taxable event. Cashing it out would. And I don't think from his question here he's thinking about that. But for everybody else listening, that's the one thing that you're going to owe taxes on. And if you're not 59 and a half, you're even going to assume an early withdrawal penalty of 10%. So you could, in essence, lose 40% of that 401k balance by cashing it out. So that's almost never an option. You'd have to really be in an emergency situation with nowhere else to go for money before we would probably talk about that option. So one of the things I want to talk about too, you talked about the options. We're fond of saying rolling it to an IRA opens up the investment universe. There's almost there are some restrictions, but there aren't many restrictions to what you can access from an investment perspective once it's in an IRA, because it's in essence self-directed. You get to make some choices there from the investment universe. You are fairly restricted, quite restricted, in fact, by leaving it in the old 401k or even rolling it in to the new plan, because the average 401k plan has about 10 to 12 options, and that's it. And it may or may not help you reach your goals. The other thing I would say, if you do make a choice to roll it into the new employer plan, in most cases, you haven't put a lockbox on that. You could actually revisit that. So for people listening today who said, well, I rolled that into my new plan about 5 or 6 years ago, oftentimes if you look at your statement, they'll divide the money that came in outside the plan from the money that you've contributed to the plan since you've been an employee there, and that actually might still be eligible to roll out into an IRA.
Yeah, absolutely. Scott, I think that one of the things that we could talk about with this question is a story that I've seen play out. I'm the old guy around here, so I've got all the stories. I've got tons and tons of stories. But I have seen on several occasions people come in and they're ready to retire. Mentally, they're ready to retire, but they have accounts scattered all over the place. And we literally spend sometimes weeks trying to round up statements, trying to figure out where those accounts are. Oh yeah, I forgot about this one. Didn't I work at that place, honey, a long time ago? And I think we still have some money over there. It's a mess. And so to keep that kind of tidy as you go through your career and working at various places, to use that IRA as sort of that catch account for all of your 401k plans, to me makes a lot of sense, because then when you are ready to retire, you can take that one IRA and then plan based on the balance in that one IRA. Now, you're going to be very diversified inside that one IRA. If you got $1.8 million, obviously, you don't want to have all of that in 2 or 3 funds. You want to be in a situation where you can be highly diversified. But I do think that by employing that trustee to trustee transfer from a 401k to an IRA avoids the tax issue. And then I think that you've got to think about not going it alone when it comes to trying to deal with this and trying to get yourself in a position that you are ready to retire. Managing that 401k toward retirement makes a lot of sense.
Yeah, that's the final piece to the withdrawal strategy, right? How do you have a withdrawal strategy if you have accounts in 6 different places? Just from the RMD standpoint alone, when you reach RMD age and have to make a required minimum distribution, you have to consolidate an aggregate balance among several different places that you have money. So those are other reasons that you might consider consolidating. Definitely don't go it alone. Reach out to an advisor. We'd love to help you here at GenWealth, walk you through the ready-to-retire process and help you out with those decisions. And if anybody else is thinking the same thing, if they're in Greg's position, maybe it's not the $1.8 million, but maybe it's old 401ks laying around that you don't know what's happened to them, give us a call. Reach out to us, 866-653-PLAN. It's 866-653-7526, and have a discussion with a GenWealth financial advisor.
Can I throw one more thing in about reducing taxes? Because that was Greg's concern there. We've got a big workshop coming up on November 19th at 6:30 over in Hot Springs at the Chittum Event Center in Hot Springs. You can visit getreadyforthefuture.com/academy to find access to all of our upcoming events. But we are holding this workshop on how to reduce taxes in retirement. It is very specific to people who are retired because, you know, those kids grow up and are gone from home, and you lose those tax deductions.
Yes.
You lose a lot of that. And oftentimes there's not a lot other than the standard deduction for retired people to deal with. And folks are really concerned about taxes going up in the future. Regardless of who is in the White House, there is still an economic issue that we've got to deal with from a taxation standpoint. So we've got this special workshop coming up on November 19th at 6:30. Myself and Joel Newbern will be there. So we'd love to have you attend. Just go to getreadyforthefuture.com/academy and sign up for that workshop on November 19th.
Yeah, taxes going up, $35 trillion in the U.S. debt. With all due respect to Elon Musk, he can only cut so much.
Well, maybe Elon will loan us some money or something. It's probably a lower rate than we get from China or something like that.
Very important piece to that. One of the top concerns retirees have, every survey after survey for sure. Next question on the Get Ready for the Future show today is from Andrew in Russellville. I'm 52 with about $600,000 in retirement savings. My wife and I are worried about potential health issues in retirement. Should I cut back on contributions to fund an LTC policy, that's long-term care? Should I contribute more and self-insure? Andrew, great question, and it is a question that everyone should come up with an answer for in their pre-retirement years. So you're thinking right along the lines that we do when we work with our clients. We know statistically that 70% of Americans will need some sort of long-term care in their lives, and they definitely need to have a strategy or a plan to figure out how they're going to pay for that. Medicare does not pay for long-term care. That's something that is a very big misconception out there that people think is once I get on Medicare, I'm going to be good. So the issue and the whole question Andrew's asking, John, is how do I address long-term care? And he comes at it from the standpoint of I'm looking at my contributions to my retirement accounts. I'm building retirement savings. Should I cut back there so that I can fund or pay the premiums for a long-term care insurance policy? Or should I contribute more to the retirement account so I can build my own pool of money, if you will, so that it's prepared to be there for me, designated for long-term care? And the answer is to plan, because that's the only way you can determine, first of all, where you are. And that's the thing we need to determine first, John, is we need to know what the current contributions he is making, what it will do for him in retirement.
Yeah, let's kind of think about this very logically. There's, 50-60% chance that if you are 65 and healthy, you're going to need some type of long-term care. There's 100% chance that you're going to need to eat and pay the utility bill in retirement. So I think that you've got to prioritize what's going on as far as retirement and be sure that your income is locked down as far as retirement is concerned, that you've got a really good handle on how much living expenses that you're going to need on top of Social Security, and if you have a pension, then is there a gap there between the money that you will have coming in and the money that you need to have going out to basically pay for your living expenses? If there is a gap, then you've got to fill that gap, and that's got to be your first priority. Beyond long-term care or anything else, you've got to fill that gap. Once that gap is filled, then you're talking about discretionary money. And I would say that long-term care has a higher priority than going on a vacation or something of that nature. You need to be sure that you're well taken care of in retirement if you have a long-term care event.
Yeah, so we need to determine if your future asset level will provide enough income to pay expenses and buy the things you want. And if the answer is yes, which again can only be determined through the planning process, then you could contribute more into an investment account earmarked for long-term care potentially. If the answer is no, then you might actually need to increase your contributions for retirement income and find a way to pay for a long-term care insurance policy. And that's something that we help our clients with through that GenWealth Ready to Retire process. So let's talk about what your options are when it comes to a long-term care policy and how that might fit into Andrew's question, John, because again, he's trying to figure out where to allocate dollars. That's the bottom line. So let's talk about where long-term care policies are and maybe when people should be looking into that. Andrew is 52, and he's kind of on the verge of thinking about that, but there is kind of a sweet spot as far as an age goes to when you should look for long-term care insurance.
Yeah, there is traditional long-term care insurance, and I was reminded this week of the problem with traditional long-term care insurance. The premium goes up. There is one company that I was reading about that in 2025, they're going to impose a 100% rate increase on their traditional long-term care policy because of claims experience, meaning that they're paying out more than they're taking in, and so the insurance company's got to raise rates. That is the big problem with a traditional long-term care policy. Now, they're out there and they're more affordable than a hybrid policy is. We'll get to a hybrid policy in just a second, but the traditional long-term care policies are under great pressure to actually cover these rising expenses of healthcare in a long-term care situation. So that's very, very hard to budget for when you are on a fixed income in retirement. So Scott, that is why we lean toward a hybrid long-term care life insurance policy, because there is a lot of fixed assets or fixed attributions to that long-term care policy that doesn't come into play in a traditional long-term care policy.
Yeah, bottom line, when you're in retirement, you want predictability, right? You want to be able to count on your expenses not going up. So to John's point, that hybrid policy is a level premium from day one. Generally, it is going to start out a little more expensive than a traditional long-term care policy. And there's a reason for that, right? Because you're buying a life insurance policy. Somebody is getting paid. There is a death benefit on a pool of money. And if you need to draw on that for long-term care, you can. If you die suddenly and you never need long-term care, the death benefit is passed on to your beneficiary. So since someone's getting paid, there is a tendency for that premium to be higher in the beginning when compared to a traditional policy. But that traditional long-term care policy, as John mentioned, has a tendency to go up. So over the long term, it might not be more expensive. What it also allows you to do, since you are designated the amount of money that you are going to purchase with this insurance, is you may not have to insure for the full cost of care. If you think about making a retirement income plan for a couple, and let's say they're going to live on $9,000 a month, well, if one of those members of the couple need care, it's going to put a strain because most of that money is going to go to the nursing home. So the other spouse who is left behind is still going to have to eat and have to pay the bills, but it may not need the full cost of care, $7,000 or $8,000 a month. They may only need to supplement what they're otherwise receiving on a monthly basis from their assets and their Social Security. So maybe a pool of money that provides $3,000 a month, $2,000 a month over the course of a 3-year period might be what they need. And that, John, helps a couple potentially lower the cost of that premium.
Absolutely. Now, let's talk about the self-insurance thing. This can be a struggle because you don't really know what you're shooting for. You have no idea what the long-term care costs are, and it's all on you if you try to do this. And here's the challenge with this. If you take a look at perception versus reality, the average American couple estimates the total cost of health care in retirement to be $41,000. However, in actuality, the average 65-year-old couple retiring this year can expect to spend an average of about $315,000 on healthcare expenses throughout retirement. So big difference there in expectation versus reality. And 55 to 60 is really kind of a sweet spot to begin to look at these things. Most people think, I'm not going to need that till I get old. Well, the older you get, the higher the premiums are in either life insurance or the traditional long-term care policy. And trying to match that accumulation for when you need it, if you're trying to self-insure, can be a real problem, because if that long-term care event happens before you're ready, then it's just going to be an inadequate amount of money there to address the need.
Andrew, we're going to name your question the question of the week, and we'll send you a free Get Ready for the Future Show tumbler. All you have to do is email us at show@getreadyforthefuture.com to claim it. Our next question is from Christy in Maumelle. I've got a few mutual funds, but I'm worried about asset allocation. I've got growth and aggressive growth, but nothing that's considered more quote-unquote safe. I'm only 47. Do I need to diversify? Well, Christy, if you have a few mutual funds and that's all you have, you're probably not adequately diversified. But I think it's important to talk about the difference in what you may be thinking is diversifying and what we would consider diversifying, because she's talking about asset allocation and leaning towards something more safe. And I don't think, John, at age 47, that's necessarily the focal point.
If your focus is retirement, probably not. Retirement is a growth activity. You need to be able to keep pace and stay ahead of inflation and taxes as you build your retirement assets, as you are building your wealth. And a bond portfolio, which you would think would be a more safe option than maybe equities or something like that, that's going to be kind of a slow go for you. And so it's going to be very hard for you to stay ahead of those two factors, inflation and taxes, if you're not leaning into equities. But now, equities is a very broad term. You're in a situation where you may be focused on maybe a few mutual funds. And Scott, I have to say that in most cases these days, they're probably large cap growth funds, because large cap growth is a sector that has been on fire for the last several years. But there is more to life than a large cap growth fund. And I will tell you that to be properly diversified, again, across all of the asset classes in the equity sector makes a lot of sense. You may want to have some real estate in there. Real estate is a growth and an income type portfolio. It does provide some additional diversification, but there's a lot of different options out there as far as diversification without going into something safe, because what you really need is that compound interest taking a hold between 47 and let's say 67, a 20-year period of time there between now and retirement, that you can really make some tracks with what you've got invested.
Yeah, bottom line is you could diversify within the equity asset class. You don't necessarily have to go to what you may be thinking as safe money, because again, the ups and downs, the volatility of the market, and we don't know where these mutual funds are, but typically people are holding those inside of their retirement accounts at work, like a 401k. But if you are adding to, and it could be anywhere, it could be in an investment account, it could be an IRA or a 401k, if you are adding to, making monthly contributions, that volatility is your friend. When the market goes down, you're buying shares of those investments on sale. And obviously a safer investment's not going to be as volatile, typically speaking. But there is a need as you get closer to retirement to start to diversify into safer, quote unquote, safer asset classes. I got a graphic here to show you, because it is all about time. There's a reason that the GenWealth logo is a clock, because it is all about time. And we mentioned already that Christy's 47. So if you have what could be an 18-year time horizon to retirement, let's call it 20 years for Christy, but she's going to work until she's 67. Look at the probabilities here, if you're watching on the video version of the Get Ready for the Future show, of a positive return in the S&P 500 index. If you go all the way back to its beginnings, you can see that any single day of the market there's a probability of a flip of a coin, right?
Yeah,
53% chance you're going to have a positive one-day return in the S&P. If you go out to 1 month, it's about a 63% chance of probability of a positive return. Out to 1 year, it's 77.5%. And if you go 3 years, it's 87.3%. 5 years, it's 92.6%. And 10 years, 97.3%. So again, the point of this graphic is to say that if you have time on your side, being quote-unquote aggressive lets you work out that volatility.
Yeah, that volatility, as you mentioned, is your friend if you're buying shares in this portfolio. So over this period of time that Christy is talking about here, I think that you stay with a situation where you are pretty aggressive with what you're doing, relatively speaking. Now, I'm not saying throw caution to the wind and go into micro cap stocks, with all of your money or anything of that nature, but you do want to be invested in the economy. Regardless of what you hear on a day-to-day, week-to-week, month-to-month basis about where we are in the economy, the American economy has been, ever since it's existed, a very strong engine for wealth accumulation. And so we think that that's the place to be. We're making an assumption here that this is retirement money and that you've got a 20-year time period. If you're going to use this money in some shorter period of time, then our answer might be a little different than what it was in the last few minutes. But as long as you've got that time, Scott, you mentioned very adeptly that the clock of GenWealth's logo is all about time. And we want you to understand that concept because it's time in the market, not timing the market, that makes the most sense.
And I would say, just to wrap this up, Christy, don't go it alone. You're asking for advice on asset allocation. Work with a financial advisor. Even if those mutual funds are in a 401k and you're making the decisions on that, you could still work with the consultation of a financial advisor to help you choose among the options you have in that 401k. And if they're outside of the plan and you have an IRA, get some advice on those assets from a financial advisor because they're on top of this. We look at this every day. So just having everything in a large cap growth fund, as John said, may not be the way you need to diversify, but you can look at other diversifications within the equity asset class. And if you've got questions for us, like Christy, don't be afraid to send it to us. You can call or text to 501-381-5228. If you leave a voicemail, we might use that on the air. If you just send us a text, we'll use that. You can also send an email to show@getreadyforthefuture.com, and we may put your question on the air next week. Our final question this week comes from Haley in Little Rock. I read recently that consumer spending is strong and the economy should respond accordingly. But I'm still a little on edge. What goes up must come down, right? What type of investments should I focus on to maintain growth, but also reduce risk in a potential economic downturn? Haley, thanks very much. And you're right, the economy is currently on solid footing. Growth may be slowing, the rate of growth, but the economic data does still show that the economy is on solid footing. But the thing that you should know, too, is not being too microscopic about this. The economy is always cyclical. That's the part that you need to understand on the what goes up must come down. A recession is always coming at some point. We're going to have a recession. But here's the reality that we have to point to. From 2021 through about 2023, an overwhelming majority of the nation's leading economists were predicting an imminent recession in the United States.
Anytime.
Anytime.
It was going to happen.
Yes.
It was just a lock. So many people made the wrong decision at the wrong time for the wrong reason because these economists were running their mouth about what they thought was going to happen.
Yeah, and you think about that, John. So many people, what did we do? We had a lot of CD requests, right? And for short-term money, that worked very well for our clients and should have happened, right? But when you look at that 5%, that feels pretty good. I'm going to sit there and put no risk to principal and get my 5%. But look what the market did over the last couple of years. You would have missed out on that growth for sure if you made a decision based on what you thought was going to happen in the economy. So don't do that. What matters more than the economy is your economy. You talk about what goes up must come down. You think about our prior question. The longer you stay in, yes, it's going to be up and down along the way, but it's like an escalator. You're going to start at the bottom floor, and you're going to feel like maybe if you run up and down that escalator, that's going up and down, but it's steadily on that glide path, and you get to the second floor. And that's kind of the way the market is if you can ride out those storms. So generally, when she says, what type of investment should I focus on to maintain growth but also reduce risk in a potential economic downturn? The answer for Haley, John, is to plan for there to always be an economic downturn.
That's right. And that's why the Ready to Retire process is set up like it is at GenWealth, because we don't set ourselves up for failure in the Ready to Retire process. We know that time heals most every wound that you can get in the market. If you go back to our last question, the 10-year time period of the S&P 500 since 1937, any 10-year time period, the average probability of a positive rate of return is 97.3%. So we just simply stack the odds in our favor and say, okay, for the money that you're going to need 10 years plus in the future, we're going to invest that in equities because we know the chances are fairly high that you're going to get a positive rate of return. But if you are going to need money very soon, then we're going to invest that in something very, very conservative so we know that we can deliver that money to you when you need it. That's from an income standpoint. But Scott, let's also talk a little bit about how you might think about hedging an equity portfolio if you are just going, okay, I want to be sure that I don't give up what I've got or anything of that nature. So there are a lot of things, a lot of ways to hedge an equity portfolio. You can do it on a portfolio level basis where you go in and actually buy some hedging opportunities, some strategies that would pay if the market went down. Options on that portfolio can do that for you. But the thing that I want to be sure that everyone understands, anytime that you are efforting to take away risk, you're going to give up something. There's going to be some type of either explicit or implicit cost to that hedging that you're trying to do.
Yeah, I think Haley's age matters here, time horizon to retirement matters here, but there are annuities offered out there as well that will help you reduce risk and maintain some level of growth, and that depends on the provider, that depends on the product, and I would certainly say annuities are complex products and should never be entered into without the help of a financial advisor to determine what might be right for you. So that little disclaimer first, but there are annuities out there, John, that offer an index credit, right? You're putting your money in and you are going to have to lock it up for a certain time frame. So there is something called a surrender period there. So you can't expect to touch that money for some certain level of time. But during that time period, you may be able to get a portion of the index performance if it's positive, while at the same time buffering on the downside. The insurance company will protect a certain percentage of the money you put in and protect against losses.
Yeah, and essentially what you're doing there is you're taking what could be done on a portfolio level with options and actually doing it in a group type setting with an annuity contract where the insurance company is using their expertise to play those options and to absorb the risk if it's on the wrong side of the equation.
Yeah, but the planning process, Haley, is what you need to work through first. We talk about it all the time. We're planners first. We want to build the plan. We need to know where we're going before we develop an investment strategy on how to get there, because everyone's situation is truly unique, and we would never make specific investment recommendations on this show without understanding that from you first. You heard the bell. It's time for our final thoughts.
Scott, I want to go back to the workshop that we're going to do in Hot Springs on November 19th at 6:30 at the Chittenden Event Center. You can go to getreadyforthefuture.com/academy. That's /academy and register for that workshop at the Chittenden Event Center on November 19th at 6:30. The workshop is entitled How to Reduce Taxes in Retirement. I know that I get this question every time I sit down in a meeting room with a client. What are we going to do about taxes? How are we going to deal with taxes in retirement? I'm afraid taxes are going to go up. What is my best move? We're going to cover a lot of that in this workshop. It's absolutely free of charge at the Chittenden Event Center in Hot Springs, 6:30 on November 19th. GetReadyForTheFuture.com/academy to register.
My final thought, John, is I know people that listen to the program very much at all hear us say the answer is the plan.
Right.
And the reason we say that is because we really can't put anything together without knowing as much as we possibly can about you. Where you want to go? What are your goals? What do you need to achieve? And so this program, when we do the Q&A, we're trying to give you some tidbits and some directions to go to make better money decisions. But the end result always is you need to sit down with a financial advisor and plan. If you'd like to do that here with an advisor at GenWealth, it's easy to do. To get in contact with us, call 866-653-PLAN. That's 866-653-7526. And we're out of time for this week's Get Ready for the Future show. Thanks, as always, for being with us. And if you want to ask a question for the show, all you have to do to get it in is call or text to 501-381-5228, and you can hear your question on the air next week.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.